All right. Good morning, everybody. It's going to be a kind of a tricky week. We have a real big data point on Wednesday with CPI, and it's a big enough deal that the market's not really going to want to participate in too much because they're going to want to see that CPI data. And yet, on the other hand, there's so much going on that we might see the market participating anyways. We have a lot of Fed speakers today, and then we have government speakers over in England and I was going to say Japan, but that'll be later tonight. So we can see right at 11 o'clock, Bailey's going to be on. That's Bank of England governor. And it's showing an anticipated high impact probability or possibility. Semis are weak and down this morning. There was a semiconductor company last week that had come out and didn't necessarily change their forecast, but had put the word out, that they used a phrase, trying to remember exactly how it was said, but it was basically a precipitous drop on the back end of the next quarter. So now again this morning, TSM came out with some of the same kind of language that they just don't see a continuation of that robust sales. And it hit everything else, right? So NVIDIA, AMD, chips are down this morning. It's interesting. I was looking at the Fed Watch tool on Friday, and we were sitting at around 92% that the Fed is going to hike. And yet there are, analysts much smarter than me that's been around a lot longer who say that they're not going to raise rates, that the market has it all wrong. And I really want you to consider what that's going to mean if everybody's caught off sides, if they all believe that we're really going to not see a rate increase. Now, remember, the Fed can't really just come out and say that that pause word, because there's historical connotations for what it means when the Fed says pause. So that's why they used that skip language in the last meeting, right? And if they come out and say pause now, there'll be a reaction out of the market that they're kind of trying to avoid. But so far, throughout this entire COVID situation and then through the 2022 bear market pullback, all of it, the Fed has been very clear, and every time they said, hey, believe it, we're not lying, believe it. Higher for longer is what Powell said, right? Higher for longer. So the market is not believing the Fed 100%. They don't think the Fed is going to hike. And yet all these Fed speakers keep coming out saying, we need to hike again. We need to hike again. All of these, every one of them, we need to hike again. The next meeting is on July 26th. And what you want to be watching for between now and July 26th is for this 92.4% number to go down. Last week, it went from 89 to 92, I believe. From 86 to 92. So it's just a creeping right on up there, right? But we did hit 93, and now it's pulling back a little bit. So if they start to unwind that, then we're talking weakness in the equities, right? It won't make them go down per se, but it can certainly take some of the fuel out of these junior tech rally, ADR, dash for trash, semiconductor value ripping across the board kind of stuff, right? Too early? Come on, it's not that early. Good morning, by the way. So other than the Fed speakers, by the time we get through the morning, you 0-day traders pretty much have it good to go, right? You're pretty much done at that point. And I mean, it's been some great plays, right? If you trade 0-day the way I do them, it's been some great plays. Morning session and then afternoon session, 2 different times to put on a 0-day, right? Not just put it on in the morning and run it all day. All right, I added a time frame up here in the upper left. It's a blue label that will explain what time frame I'm on. A little feedback over the weekend that when I jump through the charts, I'm not always very careful with pointing out what time frame I'm on. And that can be confusing for newer people, or at least people that aren't used to looking at my charts. Me, I've seen these charts for so many years by now, they're an old friend. So the volume's a little heavier than I would have anticipated, given everything that's on the agenda for today, sitting at around 120 at 7:30. Now, it is arbitrary, right? What I have done over the last few years is look at the accumulated volume in the mornings by 7:30. So I've kind of got a feel for it. But that's all I've got, right? I've looked at it yesterday and I looked at it the day before and the day before and the day before and take that back for a couple of years. And that's why I know kind of where the numbers should be, right? There was no book that laid it out for me. It was just looking at it every day until I finally started to get an idea of what normal looks like. So sitting at around 120 is normal, especially with the move through the kill zone and the reset of the gap. And now just working its way back up to basically the 10 EMA, that's the 10-day, and or the top of the Globex at this point. You've got a little micro cup, or if we zoom out a little more, you've got an inverse head and shoulders. The thing is, it's head and shoulders are supposed to be reversal patterns, right? They can be continuations in a pullback like this in the bigger picture. But at the end of the day, basically that inverse head and shoulders is in the wrong spot. We would want it, well, depending on the time frame. So let me just get rid of that weekly for a minute. If we get rid of the time frame, that head and shoulders is exactly where it should be, at the bottom of the zone. Inverse head and shoulders. The thing is, though, it's almost done already. So quabbling over it at this point is basically moot. You use the neckline break and you measure from the neckline to the top of the head and you project that upwards. Those projections are your targets. Common logic says use 50% as your higher probability target and use 100% as a follow through or a runner target. It doesn't owe you more than 100%. So we measured this distance and we projected that upwards 50 and 100%. So 44.35 would be the measured move of that inverse head and shoulders to the upside. And then 44.43 would be 100% of that move, fighting through the 10 EMA to get there. So there was some talk at the end of the week about where do we go from here. And on the daily chart, things are looking pretty gappy and a little nasty. But when you look at it on the weekly chart, these moving averages all fanned out like this. They're spread out well. The 10 is not quite at a 45-degree angle, but it's working on it. And they're in sequential order, meaning the smallest one is at top and the biggest one is at the bottom. This is the textbook picture of health, right? That's what a healthy market looks like. Now, that's just looking at moving averages and price over the top of it. At some point, price quits being on top of it, right? But it's in stages. So first, we would need to break through this IX10 that we're in, meaning we'd have to get out of that box. Then we'd have to break the 10, close below it, break the 20, close below it. See the 10 break the 20, price below the 50, the 10 below the 50, 20 below the 50. You see how each one of those would just be another stage, another step, another signal of weakness. And right now, we don't have any of that. We're still healthy enough that if we measure the range here of this IX10, we're still sitting above the 50% mark. So until that changes, we can't consider the market to be bearish on, bigger time frames. Day trading, well, then none of that would matter. 10-day, 30-minute volume profile. The point of control is at the top. The TPO is also at the top. The shallow area is less shallow now because we've been crisscrossing through that area enough that it's starting to build out. We are developing a little bit of an air pocket down here below the 4411 cog line. We won't lose this data until when we wake up Wednesday morning. So if we can hold above 4,400, the volume profile here will have a new low on Wednesday. And what it will look like Wednesday is that we hit the low and that we bounced off of it and we went up. I'm saying it now. On Wednesday, when we go to look at this, if we haven't gone lower and the moving this profile is sitting at the bottom down here on that day, and I say these words, when we're at the low, we go to the highs. When we're at the highs, we go to the lows. Remember that on Wednesday. We are building some structure around that 4420. And if we get below the cog line, that would be that 4411. We're going to look for a reset on that 4,000, right? It's a gamma level structure. It's interesting, isn't it, that the increased volume, the heavy volume, is on the other side of 4,000. It's at 4,002, and it's below it at 43.95, 96, 94. So it actually got shallow right on the zero line, right at 4,400. It's more shallow. I guess it kind of goes with that argument, right? That you don't expect price to stop at the pivot point. Liquidity resides on the other side of the pivot. We still have a VPOC below us at 44. I bet that it's 4411 if we were to hunt it back. Well, that's kind of hard to say, isn't it? I'm in the middle. That's fair. but I would say we hit it this morning, right? But we haven't gone through it, and that's the key. Maybe we hit that VPOC. If I had used one tick higher, maybe it would have hit it, but we need to go through it. We need to have a candle close on the other side of it. And until we get that, I'm not going to count this VPOC done. 44.11. It's a cog line. So it's 43.11, 42.11, 41.11. It's everywhere you want to be. We do have a VPOC from Friday as well. And now we're kind of stuck inside these two. We don't have to hit one today, but I'm feeling pretty confident that we're going to hit one of these. If we don't, it's going to be such a horrible trading day that you're just going to wish we had hit one of these. So if you're newer to trading and maybe you aren't winning as frequently as you would like, or you're thinking, gosh, this is hard, quit doing the hard stuff. Life will be a little bit better for you. The hard stuff would be recognizing when trading will be more difficult. It doesn't mean that you shouldn't trade here. It doesn't mean that you can't trade here, just that it will be more difficult. So when we are inside the Globex range and we get into the RTH open, it's usually very choppy, very nasty, difficult to trade. It's as simple as that, right? Just look left. And if we're inside of this zone, when we get into the regular trading session, you just want to kick back and wait. Let it break out of that zone. On Friday, I waited on that breakout half the day. But when we got it, it was amazing. It was worth the wait. I would have loved to have traded that, but it was just too late in the day. So, a little bit of patience. Patience pays, as they say. And if you don't get a trade because it stayed trashy and sideways all day, you didn't miss anything. I know. We don't learn how to trade just to sit out and not trade. I get it. So someone was asking about a double top here, or maybe even a triple top if we look all the way back to August. Actually, it's August. It better be August. So, you know what? A double top is supposed to be a bull trap, and a double bottom is supposed to be a bear trap. And the idea of a good trap is that it convinces people, sucks them in, and then just spring it on them, right? You got to catch somebody. It's kind of the idea. So a good double bottom or a good double top should go through the pivot point and go on to the other side of it a considerable amount. If this is supposed to be a bull trap, we need bulls to be convinced that it's really going up so that we can trap them. Then we would have wanted to go higher through here, right? And then reverse it on them so that we can trap them, capture them, make them add to the selling, and then we can go down really fast. But instead, all we got is this little itty bitty wick, and we pulled back, which makes sense because if this is liquidity or unfinished business, and we came up into it, struggled to get through it, we didn't get through it, and we fell back down. How much more liquidity is there up here? And if we revisit it, will we be able to get through it next time in a single shot? Or is it going to take multiple tests before we finally get through it? And are there still, enough players to run this up? But either way, is it a double top? Sure. Yes, absolutely. Textbook, it is a double top. But it's not one that I would look at and think, ooh, bull trap, gotcha. Instead, it really implies a little bit of the opposite. Let's zoom out a little bit here. Not using OCR, right? Not using OCR. You do have these pullbacks. And what you've got is higher low, and a higher low. Now, granted, we lost our higher high. That is true. And that's where we get into a little bit of a pause. That we're not bearish at this point, but it'd be hard to keep a bullish argument until we can get a new high. Right now, closing highs versus just a higher high. We did get a higher high. We just didn't get a higher close. That little wick right there gave us that higher high. So now we can say that we have higher lows and we've got higher highs. And two higher lows with two higher highs is the confirmation of trend. So that tiny little wick right there confirmed trend. And we can keep that confirmation or that bias until we break this low and we get a new lower low, which probably would also then give us a new lower high, right? Lower high, lower low, lower low, lower high, and we would trend in the other direction. So until that changes, trend is intact. It makes sense, yeah? All right, we are just barely slightly below the 10-day, which means we are interacting with that 10-day on a daily basis now. And we are going to continue to do that until we finally drive away from it. But we are still really close to 2% away from the 10-week, and we're above it. And being above the 10-week is just straight up bullish. The fact that we're paused here on the weekly and we're giving that 10 time to catch up with us is a really healthy thing. It did it back here too, right? When we drove and crossed through the 10 and just paused there and waited for the 10 to get caught up with us, and it creates a little bit of a wedge and we just explode out of that wedge. And now we're doing it again. We're just sitting there and building up more and more and more energy while waiting for the 10 to get caught up. The average daily range for today is yesterday's high. That is 1%, right? We got a 1% ADR. It's the yellow line. And if we were to measure from where we opened up 1%, it would get us through yesterday's high at 44.76 and a little higher up to 44.81. Half the ADR is 44.60. And in the other direction to the downside, half the ADR is 44.15. Then we got the cog line and a voodoo line at 44.11. Another voodoo line at 33.96. And then the full ADR at 43.94. We have an MDP this morning as well. MDP is a missed daily pivot. So there's a daily pivot point here in purple on my chart right underneath the weekly pivot point. The markets generally hit their pivot point about 80% of the time, maybe a little more. And so when it doesn't do that, it kind of stands out, right? It's in the minority at 20%. So it doesn't mean that it can't hit it today, right? We talked about being in an MDP on Friday, and that lasted all the way up until 8:30 when we got data. So, we can certainly hit it. The missed daily pivot comes in more at the end of the day when you look back and realize, ooh, today was an MDP, because it carries into tomorrow what we would make decisions based on at that point. All right, so it's not my strategy. I don't trade it. And since it's not mine and I don't trade it, I don't teach it. You could certainly find it easily enough. Just go to Google, maybe YouTube, type in missed daily pivot. You'll find it. It's not hard to find. And if you're thinking, why would I go learn it if I'm not going to trade it? Well, it actually teaches you a little insight, right? So you can use it for analysis like we're doing here, rather than using it for a tradable opportunity. And you'll find that to be true with a lot of strategies. You might not want to trade them, but they can offer you some insight. There's a rumor that the NASDAQ is going to be rebalancing with a reduced Apple and a reduced Microsoft. I don't know exactly how that's going to affect the market, but it can't be good, right? So what we're looking at here is US dollar Japan on a daily. I'm going to take it over to a weekly for just a moment. Yeah, I think the weekly will work. So looking at the MACD, the primary trend is up. The secondary trend is up. They're both up with strength. Rate of control, the ROC, is above 0. Was above 5. Still coming in a little bit, but the fact that it's so strong and healthy above the 0 line implies that the rate of change is still good. The only thing that we have is this week, last week, where we closed down. It's not exactly a perfect Marbozu, but there's no wick on the bottom here. Still have a wick on the top, but we're above that 10. So the 10 is in focus. If you're long gold or silver or miners, which, hey, I get it, that drop in US dollar Japan would have really lit those precious markets up. But if we bounce here and we start moving to the upside, your gold and silver and precious metals and miners are going to get gut punched. So just a little bit of caution, right? If this continues to the downside and catches on that 10-week, we call it a fade into support, right? And then a rally into resistance. And then we'll have to have a little bit of a check and balance at that point. This is the same thing that we were looking at earlier, right? Still got higher highs. We still have higher lows. And until we get a lower low, US dollar Japan is still bullish. So it's going to affect you guys that are long gold, silver, and precious metals and miners if we get that bounce. So on the daily, we're underneath the 10 already. You can put on the others to see, 20, 50, 200. What you want to be careful of is a bounce, right? If this bounces and gets a rally, you're going to feel it in those precious metals. US dollar China looks a lot better, right? It's still holding above that 10-day. It's way above the 10-week. Made it through that zone. So we'll just take that and put it higher. This needed a pause, right? So now we got this bull pennant, which it's inside week IX10, because now we're on, third week. But it's a pretty good sized week. So it's not like it's a compressed week and then we're inside it, like back here with all these in a row, compression, follow through. It's more like this one. reasonably decent follow through. Or that one. So it's just getting started, right? If you don't count the week that formed the IX10, then we're only in our second week. Needs to get out of this box. But what's more likely is that we stay in the box, maybe wick down a little bit and wick up a little bit, but we basically hold this range while we wait for the 10 to get in here, and then either break the 10 like we did back here, or we stay consolidated, wait for the 10, and then we bounce on it and continue to go like we did back here. So one or the other. Either way, some sideways trades in things like FXI, you'd want to go long, right, instead of short. It's I mean, when you look at that, you think, I don't want to go long in this. It looks nasty. It certainly looks nasty. That's a weekly chart though, and we have an inverse head and shoulders here. Just remember, it's a weekly chart with an inverse head and shoulder. It could take an entire year just to form the shoulder, which we saw from 2022 into 2023. That's just left shoulder head. Then we got head, and we're still looking for the right shoulder, which hasn't yet confirmed. So, you know, we're just talking about a short-term trade to the upside. We're not talking about revisiting a 2-year trade that get us into the 50s. So with that in mind, maybe credit spread. I mean, you could sell a put spread and then, I don't know, buy some calls if you wanted to play the directional side. The main thing is, we were talking about this not being bullish, right? It's just on pause. And then trading this on pause. There's no directional bias to that. There's no momentum. We're not talking about trend. And if you're going to buy an option, you kind of want to know price is going to move, right? You need price to move if you're going to buy that call. So higher conviction trade, just sell a put spread. If you got the capital, just sell the put. Don't even bother with the spread. Selling the put, or selling the put is easy to defend, whereas a put spread, not so easy to defend. I mean, these moves in Germany are looking pretty good, right? And that's a new high on the year and a new high on this chart, which, you know, I mean, I only got 2018 here. If we were over on stockcharts.com, we could look back farther, but that's the highest that I've got, right? And that got a little weight to it. So I don't use an ETF on Germany, but, you know, if you wanted to trade a 52-week high breakout, go long Germany. I could have swore there was a couple of analysts that were short Germany and remained bearish on Germany overall, only counting this as like a rally into resistance. So keep that in mind. If Germany's a short, then it's a perfect short off the highs. Get like an LRE, right? Low risk entry. You might not have any confirmation of the short, but there's no better place to short it cost wise or risk to you than where it is now, sitting at these highs. So that's something to think about, right? That it'd be a great short even without confirmation. So crypto's not looking too bad this morning. It's a little bit of a mixed bag. We can see that the some of the crypto names like Nvidia, PayPal, those are down. Nvidia is not down enough to meet our benchmark. It needs to be down at least 0.5% for me anyways. if we were doing the morning briefing later in the morning, say if I started it at 8:30 instead of 7:30, then I'd probably change that benchmark to 1%, right? But I use a 0.5% because of my time frame on when I start the briefing. But in the crypto space, we still have names. Well, that just rebalanced, right? Let's run that one more time. Looks like TrendSpider had a little glitch there. NVIDIA up. Now it's just shaking around all over the place. Mara, Riot. Getting some flows in here at 8 o'clock this morning. Remember the dollar, the bonds, they all open around that 8 window, right? You got like 8:15 and 8:20. And so it wasn't bonds. Wasn't the dollar. It's really close. 10-year making a move to the downside. ES getting really close to a Globex high. And the NASDAQ also really close to that Globex high. It made it through that voodoo line like a champ. I mean, that was impressive. So the big deal right now is the 10-year. We got to see that thing calm down, get back down below 4%, but it needs to move easy, right? We don't want some exaggerated motions in the 10. So like, what is it? How does it weigh on us? When I got up this morning, I was listening to the news and I heard on Bloomberg, they do that little segment and they just rattle off a bunch of stuff. Gold is here, silver's there, the 10-year is above 4. They hadn't even got to the equities yet. And I was pretty sure I was going to hear markets were down because the 10-year was still holding above 4. So, it's not the idea that the 10 is going to drive us down. It's just weight, right? It's a weight against the market going up. So as long as we see that 10-year continue to hold sideways, but better go down, then the S&P can continue this rally. One thing I'm going to point out is that we have stocks and bonds both rising this morning. Risk parity is dead, right? The old 60-40. Again, someone said COVID killed it. I'm not taking that phrase, it's not mine, but I still love it. So continue to watch for a divergence, right? Watch for the stocks or the bonds to break ranks and go in the other direction. It'll be a tell, right? It'll give you the heads up that something's coming. You might not know what, but at least you'll know something's coming. Yep, it is. It is up. When I first got to TrendSpider, the watch list, I don't know, wasn't updated yet. Every once in a while, it acts a little wonky, as all brokers and charting platforms do. Every once in a while, it does something a little goofy. So energy's down a 0.5%. Which makes sense because we've been in this range, right? We normally look at like WTI. We don't have this bottoming pattern finished yet, but we chopped through here, getting these higher lows until finally we broke down through it, still came back and retested these highs and weren't able to to pass through. Give me my line. And so, the range is clear. And of course we can tighten all that up and just get smaller and smaller. But we need to get out of this range or this zone. Right now, that week is the week that's in control. That'd be the first week in May. And if we get rid of that wick, structure's a little tighter, but it's still there, right? So with energy, you got to figure we're going to stay inside here just chopping and chopping and chopping. And there's no play unless we're along the edges. Got to get there first. Getting a little bit of rebound on Apple. Just if you want to kind of see what it looks like when the index is rebalanced, the Russell just finished rebalancing not too long ago. And now the NASDAQ's going to rebalance, right? Those are weighted indexes. And so the balance gets rebalanced, right? And some names get taken out, new names get added in. All right, we got this gap close. I mean, it depends on how you read it, right? If you look at the NASDAQ and the futures, then there was candles all night, no gap. But if you look at the Qs and you use like after hours and then pre-market, then we have the gap down and now the gap is closed. Just like this gap here took 2 days to close it, but opened gap down, ran around for 2 days, finally got back up there, closed it, back down we went. So the idea today, let's get out of the range. Keep your eye on the sectors that are in play, which is basically everything except energy, right? When we come up here and look, nat gas is leading the way. Then we got airlines, semiconductors, industrials, except, the benchmark is 0.5%. And other than nat gas, none of these meet that criteria. So we need a little bit of something, right? We just need more information. So I'll leave you guys with that. Keep your eye on the sectors and look for the change to come in, right? Give it a little time this morning. Remember that the RTH open is when we get price discovery, right? We're putting in all of the news from the overnight. And on Mondays, that's even more important because it's got all the news from Friday night, all day Saturday, all day Sunday, and then Monday morning through the overnight. So there's a lot to price in. Give it that little bit of time this morning. And remember that we got all these Fed speakers and government agencies around the world coming out today with data and speaking. So something like FX Street, watch the news, see the numbers that are coming in. And if we do start to see anything change, it should be sector growth, right? It should be not growth, should be sector. So one individual name, right? See Baba moving or Neo or something, whatever, that's one name. Check up with it. If it's a EV name, then check the other EV markets. If it's a crypto name, check the other crypto markets. It's not complicated stuff, right? And speaking of those EV names and semis, you know, I mean, look at Lee or Neo, just kind of getting started. But legacy name like Ford. Or GM. Getting closer to a retest of this range top. That'd be nice. So GM is basically where it closed on Friday. It really hasn't moved anywhere yet. That might be one worth watching. We just got that breakout on Friday. And it kept it closed higher. That's higher high, higher low, higher close. It's a continuation of this move until it isn't, right? Now, one of the issues with GM, and it's why it makes it such a good play for you today, is you've got these very clear boundaries on each side. So a breakout above 40 or a breakdown below 39.32. It's an either or, and it's really clean, right? We closed lower on Friday than I would have liked for a bullish continuation. We're below that 50% mark, right? So I don't like that. This morning, what we'd want to see, if you're looking for, you know, a trade here, say short first. We open up, maybe we open a little gap, or we just run up and we test the close of yesterday, and then we head to the downside. Shorting off the highs for me is preferred rather than shorting off the lows. So I'd love it if we can go all the way up to 40 and then drop, but that's asking for a bit much. Getting it anywhere across these pivot points, short against the close or short with a breakdown below the open of yesterday, I would still like either of those better, but the confirmed breakdown would be breaking outside of yesterday's zone. Right, so breaking the low of yesterday. If you're waiting for a bigger swing trade signal short than last week's candle, so from a quant point of view, using that quant tool, quadrant lines, staying below the 50%, or in this case, breaking below the 50% would start the short. You can increase your short position size if we break completely outside of the week. And if we did that, then just go to the next week, which is the big week. And your target would be 37.44, a line in the sand, midpoint. Very likely that we would bounce there, rally into resistance before rolling over and continuing to go lower, right? And then lower and lower. I'm off here, guys. Be careful. Be safe. Have a good day. And I will see you all tomorrow.